Are you using one of the most powerful tax-efficient withdrawal strategies available to your retirement? Now, there are a lot of different tax-efficient withdrawal strategies that should ultimately be tailored to your specific situation. But there is a very general and very simple tax-efficient withdrawal strategy that we've noticed opens up a lot of tax savings for many individuals. Now, this withdrawal strategy hinges on when you file for Social Security. And in this presentation today, we're going to show how optimizing your Social Security benefit can create something that we call a Social Security cleanup zone that can translate to tax savings throughout your life. If you mistime your Social Security strategy, we'll show that it can lead to a chain reaction of destructive tax penalties that you will face on an ongoing basis, again, throughout the rest of your retirement. And so let's get into it. Now, I want to tell you a story around a couple that we met with mid-January, and this couple had just retired at the beginning of 2022. They happen to be 63 for the husband and 64 for the wife. Now, they have some sizable retirement assets, $1.8 million in retirement accounts, primarily in tax-deferred accounts, primarily saving inside of their 401ks because throughout their working career, they got that given match. So they just kept plowing money, getting that tax deduction, and plowing money into their tax-deferred accounts. Now, their current advisor told them to file for Social Security as soon as they retire. Their advisor told them that the only way to know the absolute best time for them to file is know when they're actually going to pass away. And obviously that is something that we don't know. And so their advisor told them as soon as they retire, they should file for their Social Security benefit. That will mean they're taking less from their portfolio in those early years. And if there are any cuts or changes to Social Security moving forward in the future, they will have some protection because they've already filed for their given benefit. And so this couple wanted to take a reasonable $80,000 of income net of taxes and healthcare. And so on the screen right now, you'll see what their income analysis looks like at first look. And what we see is they file for Social Security in this dark blue right here as soon as they retire. And again, that feels like a very good decision because as their advisor said, this means they'll be taking less from their portfolio in those early years. But as we see, they have the majority of their money in tax-deferred accounts. And so by delaying Social Security, yes, they're taking less from their portfolio, but that means that they're taking less from their tax-deferred accounts. And so in the first part of their retirement, their tax-deferred accounts are going to grow larger and larger. And then they have a rude surprise once they turn 72. As we see on the screen here, these green bars are required minimum distributions. At 72, they're going to be forced to take money from their accounts, whether they want to or not. And we see that these RMDs grow very large quite quickly, push them well above their income need. In fact, in 2037, we estimate that in Trial 500, out of the 1,000 simulations that we ran for their situation, they have a $135,000 required minimum distribution, far above their income need at that time. This means that they're taking very tax inefficient withdrawals. They're forced to take an income from their retirement accounts. And anytime this happens, this is a golden rule of tax planning. We want complete control over our withdrawal strategy. Anytime we're forced to take income from any of our given accounts, that's likely going to be less efficient than if we have control and we are able to optimize our situation. Now, the problem here is they've already filed for their Social Security benefit. They filed and were set to take that benefit right away when they retired. And so they had already filed. And so does that mean that this was an irreversible decision? Well, no. Actually, within 12 months, they're able to pay back any income that they've received from Social Security, essentially reverse their filing. And so this is what we recommended for their situation. And I'm going to show in this video exactly why we recommended that. Now, the first mistake that their advisor made was significantly undervaluing Social Security. Now on the screen right now, I'm showing the actuarial reduction and delayed retirement credits that you earn from either taking Social Security early or delaying Social Security. Now, each of their full retirement ages were actually in that 66 age range, 66 in so many months. But nonetheless, I'm going to show full retirement age here being 67. And what we'll notice for every month that you file for Social Security early, you receive a permanent reduction. Now, on an annual basis, this translates into a 5 to 7% full reduction in benefits. For every year they delay past full retirement age, they get an 8% step up in benefits. And so the difference between filing as early as 62, and now granted they were obviously past 62, versus delaying until age 70 is a 77% difference in monthly benefits. Now this is a huge difference when we're talking about guaranteed income. And not to mention in today's low interest rate environment, how powerful that step up or reduction in benefits actually is. When we're thinking about allocating to safer assets like cash or bonds that are earning, next to nothing, those 5 to 8% step up in benefit is an incredible trade-off for delaying Social Security. And again, it's on a guaranteed basis. But let's also look at this from a tax perspective and start to talk through what some of these chain reaction issues are. And so we'll notice here looking at a tax graph in their Trial 500 here, that again, when they file for Social Security as soon as they retire, that feels like a very short-term good decision. Again, because in the short term, they will end up with more money in their retirement accounts. This makes sense. If they were to delay Social Security, they would have to pull fully from their retirement assets. Those retirement withdrawals would decrease and put stress on their portfolio in those early years. And so filing for Social Security as soon as they retire means they'll be taking less from their portfolio over time. But the problem is this short-term decision has a very long-term consequence. So right now we have certain things moving in our direction. From a tax standpoint, we are in the Tax Cuts and Jobs Act window of opportunity. This is set to end in 2026. We'll talk about this in a second, what value this has to your retirement. But we see here on the screen, as we look in the background, we see the tax brackets moving through time. You'll notice this adjustment in the tax brackets right here is the Tax Cuts and Jobs Act expiring. Essentially, brackets are going to rise in terms of their total tax rate, and also brackets are also going to adjust a little bit. And so in the first 5 to 10 years of their retirement, they are in some very low tax brackets. And short term, again, this feels very good, but the problem is it delays all of these problems for the long term. And now as we see, as soon as they turn 72, they're forced to take RMDs that are up and above their income need. And this is pushing them into higher brackets. And this is going to, again, have a chain reaction of issues. First, they're being pushed into higher brackets. So anytime you're forced to take excess income that you don't need and that's pushing you into higher brackets, it means that you're losing a large amount of that excess RMD, that excess income, to taxes. Not to mention that those RMDs are pushing them up into Medicare premium adjustments, so something called IRMA. And so because of these large RMDs, they're going to notice that they owe extra in terms of Medicare expenses on an ongoing basis. And again, once RMDs start, it's very difficult to deal with these issues. If you're forced into an IRMA threshold because of an RMD, you're likely going to be forced into that threshold next year, the following year, and on an ongoing basis. Now, there's another adjustment that we see in the tax brackets later in retirement. Now, what is this? This is essentially illustrating the husband passing away and the wife surviving him for a few more years. And when this happens, again, because of the closeness of their ages, that wife is going to inherit his tax deferred accounts and have a very similar required minimum distribution. But here's the thing. She's going to enter something called the widow trap. While they were both still alive and they had these large RMDs, they were under the married filing jointly brackets. But now, because she is surviving on her own, she is subject to the single filer brackets, essentially from this point on in retirement. And what this means is she has half as much room in each bracket. She has half as much room in the standard deduction. Her IRMA brackets are half the size as well. And so what we see here is those RMDs continue to grow and actually push her up into the 33% bracket at this point in time. And so across the board, this short-term decision that feels good ends up having some pretty bad tax consequences and a chain reaction effect of these bad tax consequences throughout the rest of their retirement. And so what should they do instead? Well, they should create a cleanup zone by delaying Social Security, and at least to an extent. Now, in their case, it made sense for them to delay as late as 70. For everyone's situation, that might look a little bit different. But this cleanup zone creates an opportunity that we will really never have again within our retirement. And the reason is because there's a couple of things working in our favor from the ages of retirement to the time that you begin Social Security benefits. Again, once you file for Social Security, there's a lot more complexities because the more income you take from taxable income sources, it forces more of your Social Security benefit into being taxed. And so there's a double taxation effect that happens where once you file for Social Security and then finally once RMDs begin, it's very difficult to have that much control over your situation at that point in time. So early in our retirement, we need to be making decisions in order to affect the greater length of our retirement. And again, this means that delaying Social Security, specifically past Medicare age, opens this window of opportunity where we can pull large tax deferred withdrawals from our situation and we can perform large conversions on top of that. And again, this is a little bit more souped up by the Tax Cuts and Jobs Act that is still into law until 2026. But again, two things are happening inside of this cleanup zone. We're increasing the value of our Social Security benefit by delaying, and we're leaving room here to implement some tax strategies to deal with future tax problems that we estimate we will have within our situation. And so let's quickly touch on this tax window of opportunity due to the Tax Cuts and Jobs Act. So the Tax Cuts and Jobs Act was put into law in 2018. It is set to expire in 2026 and revert back to the old system if Congress doesn't do anything. And the Tax Cuts and Jobs Act was pretty powerful from a tax-paying standpoint. It raised the standard deduction by about $10,000 for a married couple and lowered each bracket by about 2 to 4%. And so right now we are in a window of opportunity that we may never see again to pay taxes as low as we are seeing them right now. For instance, in 2026, the 12% bracket is going to become the 15% bracket. The 22% bracket is going to become the 25% bracket. The 24% bracket is going to become the 28% bracket. And so if we think about it right now, again, leaving out any state income tax that you might owe, we can pay taxes in the 22% bracket and even the 25% bracket, and eventually we're taxed in the 25% bracket, what was previously the 22% bracket, we are gaining a tax benefit. So we actually want to be paying more in taxes over the next couple years, again, to improve our situation for the majority of years thereafter. And so as I mentioned earlier, in their situation, it's going to make sense for them to delay Social Security all the way to 70. That might not be the case for your situation. Every situation is slightly different. But looking at Social Security, we can't just look at Social Security in a box. Now, it's important to know all of the benefits and drawbacks to taking Social Security early versus delaying Social Security. It's important to know how your Social Security benefit adjusts through time and where the break-evens there are. But we can't just look at Social Security as a standalone asset. We always have to be looking at this inside of your retirement plan. And as we see, by delaying Social Security, we gain some extra benefits from a tax strategy standpoint. And so first, what we'll notice in current dollars and total lifetime benefit, based on the life expectancy that we uploaded for this given couple, we notice that the total lifetime benefits was the highest if they delayed till age 70. Now, this is common if you're looking at some fairly lengthy life expectancy. Okay, so this should not just be the standalone number that we look at in order to make our Social Security decisions. We should also be looking at how it wraps into our probability of success. We'll notice here that their probability of success rises by about 2 percentage points by taking at age 70 versus if they filed as soon as they retire. We'll notice that the difference in the first year benefit is quite drastic between filing as soon as they retire versus delaying all the way to 70. But again, the most important thing here is looking at how each Social Security timing strategy wraps into their overall plan. And what you'll notice here is their break-even point falls pretty drastically when we're looking at all of the other strategies that we're implementing for their situation. And so let's first look at the simple benefit they gain from simply delaying their Social Security benefit, not performing any conversions, but instead taking all of the income that they need from their tax-deferred accounts. Obviously, because of that, they're going to be lowering those tax-deferred account balances in those first years as they're delaying Social Security. This is a guarantee. And so we see for the first part of their retirement, they're taking almost all of their income from their portfolio withdrawals. Again, what this is going to do is essentially decrease RMDs, at least temporarily. We notice looking at the same exact 2037 RMD estimation, we see that rather than being around $135,000 in a given RMD, it's only at $93,000. So it lowers that given initial RMD by about $40,000. Now here's an important thing to understand. Delaying Social Security for their situation only minimizes RMDs temporarily. Again, this kind of makes sense if we think about all of these things that are happening from delaying Social Security. Yes, they are pulling more from their assets during this period right here. But as we can see, once they file for Social Security, they're pulling far less from their assets. And so the early years here of RMDs are going to be much smaller than they previously would have been. But they catch up very quickly because, again, they're pulling less from their assets then for those first years, allowing those tax-deferred accounts to essentially grow unencumbered. And so, again, on the back half of their retirement, we still see some very large RMDs here that are still forcing them into some very negative tax consequences. But you'll notice that by delaying Social Security, we did get some RMD relief at the very least. We now have more coming from Social Security, which is a more tax preference asset. More of our income is going to be inflation adjusted through time. And there are a lot of benefits that happen just from delaying Social Security. But we need to also couple this with other tax strategies. For instance, some of these strategies that they could be using are Roth conversions, specifically in this Tax Cuts and Jobs Act window of opportunity that we're seeing right here. So for instance, the 24% bracket is especially powerful right now because it is turning into the 28% bracket. The 22% bracket is turning into the 25% bracket. So we can essentially pay 22 and 24% in order to avoid being taxed at 25% later in retirement. And we'll see that's exactly what we want to do in their specific situation. Now, a point to keep in mind here is we are looking at maxing as much of that 24% bracket as possible for their specific situation. But there are some IRMA thresholds that we need to be cognizant of as we're planning through these. This couple will be hitting certain IRMA penalties and will see a Medicare premium increase due to these conversions. But nonetheless, these conversions still make sense in their specific situation. And so maxing this 24% bracket for these first 4 years underneath the Tax Cuts and Jobs Act will drastically minimize these tax-deferred accounts and move those tax-deferred accounts into a Roth account where there will no longer be an RMD from those Roth IRA accounts. Then once the Tax Cuts and Jobs Act fades out, we then want to be maxing out the 25% bracket for an additional 3 years. Again, we'd rather pay 25% in taxes in order to avoid some of the negative tax consequences that RMDs will have inside the Social Security tax torpedo. Now, what you'll see here, if I move my head out of the way, is this translates to some pretty significant estimated tax savings throughout the rest of their life. We'll notice that we almost fully eliminate RMDs. So at this point, the only thing we still have left is a little bit of pension income as well as a little bit in RMDs. And again, that's still forced income, but there is a portion of RMDs that we are fine taking. Those RMDs will still force some of our Social Security benefit into being taxed, but tax in brackets and taxed at rates that we're fine paying because it wouldn't make sense paying higher rates inside of our Roth conversion strategy. And so what we did for this person's situation is in the first 7 years of their retirement, we are setting up the rest of their retirement, the majority of their retirement, for tax efficiency. And so how does this make them more tax efficient inside of their Social Security tax torpedo graph? For the length of their retirement, once they're on Social Security, how do we ensure that they're saving significantly from a tax standpoint? Now, if they were just delaying Social Security and they weren't performing any Roth conversions inside of that Social Security cleanup zone, we would notice that they would still have some pretty large RMDs. In red here, you can basically see their RMD zone, basically where RMDs would grow to and stay in as they move through retirement. And as you see based on the Social Security tax torpedo, this puts them in some very negative tax zones. And for those that aren't familiar with the Social Security tax torpedo, essentially what's happening here is the amount that you pay in Social Security taxes, or the amount of your Social Security benefit that is taxable, is determined by how much other taxable income you take in. Essentially, taking $1 from, let's say, an RMD will force 85 cents from your Social Security benefit into being taxed. So taking $1 from your RMDs will force $1.85 into being taxed at your given rate. And so we see an increase due to double taxation inside the Social Security tax torpedo, where you will see your marginal brackets rise by anywhere from 50 to 85%, depending on what Social Security taxability threshold zone you are currently in. And so what you'll see here in blue is their marginal tax bracket, what they're actually being taxed at as they're taking taxable income in the form of RMDs. In red, you'll notice what they think they're intuitively taxed at, or what the normal tax brackets are. So we see the 10% bracket turns into the 18.5%, the 15 turns into the 27.75%, and the 25% bracket, until Social Security is fully taxable, turns into this 46.25% zone, a very destructive zone. And we notice that previous RMDs will push them fully through the Social Security tax torpedo, subject to very high taxes. Versus when they delayed Social Security and they dealt with those RMD problems during that Social Security cleanup zone, we see that now their new RMD zone is very narrow, and we're actually paying taxes at rates that we should be completely fine paying taxes at. Now, there still may be some room for some ongoing smaller conversions. Again, if we're taxed within this zone and we can convert a little bit more to avoid being taxed within this zone in the future, that might still make sense. But the big point being is that we converted at 22%, 24%, even 25% in order to avoid 27.75%, 46.25%, and then 25 and 28%. So this makes a lot of sense when we think about the rates that we would be paying right now versus the rates that we would be paying in the future. We are gaining a huge tax benefit by optimizing our Social Security timing strategy, creating this Social Security cleanup zone, and then implementing tax efficient tax strategies within that given zone to deal with the issues that we will see for the length of their retirement. Notice that when we go back to this graph, we've also completely eliminated a lot of the risk that we're seeing, a lot of the large tax expenses that we're seeing inside of that widow trap as well. And we're completely avoiding IRMA for the majority of these given years. We may be taking some IRMA expenses through these first 7 years, but that's completely fine and acceptable as long as we're avoiding IRMA for the majority of these years moving forward into the future. And so this is a very powerful tax efficient withdrawal strategy that applies to many retirees. Again, most of us have a Social Security benefit. Most of us have saved the majority of our income within tax deferred accounts because we've gotten those tax deductions. We get a match inside of our 401k for contributing to those tax deferred accounts. And so many of us have the majority of our wealth inside of those tax deferred accounts that can mean a very large tax liability moving forward into the future. Now, if you like this video and you want to learn a little bit more about additional tax efficient withdrawal strategies, I highly recommend clicking on this video right here where we recorded a Wealth Wednesday fully explaining and diving deeper into the Social Security cleanup zone and other tax efficient withdrawal strategies that you can use for your retirement. Thanks for watching. We look forward to seeing you in the next video.